Investing is about growing your money. You're putting it to work for you. Instead of just sitting in a bank account, investments can earn more over time. Think of it like planting a seed. With time and care, it grows into a tree that bears fruit. There are different ways to invest, each with its own risks and rewards. It's important to understand these before you begin. Remember, investing is a long-term game. It's not about getting rich quick. Investing helps you reach your financial goals. Whether it's buying a house, retiring comfortably, or securing your children's future, investing can help get you there. Before you invest, it's crucial to have a solid financial foundation. Pay off high-interest debts and build an emergency fund. This way you're investing with money you can afford to grow. Stocks are like little pieces of big companies. They represent a fraction of ownership in a corporation, giving you a stake in its future. When you buy stock, you're buying a tiny share of ownership in that company. This means you become a part owner of the business, no matter how small your share might be. If the company does well, the value of your stock goes up. This can lead to significant financial gains over time, especially if the company continues to grow and succeed. If the company struggles, the value of your stock goes down. This is the inherent risk of investing in the stock market. Companies sell stocks to raise money. This capital is crucial for their growth and development. They use this money to grow their business, develop new products, or expand into new markets. This can lead to more job creation and innovation. When you buy stock, you're giving the company money to do these things. In return, you get a share of their future profits and growth. There are two main ways to make money from stocks: dividends and capital appreciation. Both can provide substantial returns if managed wisely. Dividends are payments made by the company to its shareholders, usually from its profits. They provide a steady income stream. Capital appreciation is when the value of your stock increases over time. Stocks can be risky, but they also offer the potential for high returns. The stock market can be volatile, and the value of your investments can fluctuate. It's important to be prepared for these ups and downs. It's important to diversify your portfolio and not put all your eggs in one basket. Diversification helps spread risk and can lead to more stable returns over time. Bonds are different from stocks. When you buy a bond, you're lending money to a company or government. They promise to pay you back the money you lent them, plus interest, over a set period of time. Think of bonds like IOUs. You're essentially loaning money and receiving interest payments for doing so. Bonds are generally considered less risky than stocks. This is because bondholders are paid back before stockholders if a company goes bankrupt. Bonds offer a fixed income stream. This means you know how much interest you'll earn and when you'll receive your principal back. This makes them a good option for investors looking for a predictable income stream. However, bonds typically offer lower returns compared to stocks. This is because they are considered less risky. Additionally, the value of your bonds can decrease if interest rates rise. Section 4. Mutual funds explained. Mutual funds are like baskets of stocks or bonds where your money is combined with that of other investors. When you invest in a mutual fund, you're pooling your money with other investors to buy a diversified portfolio of assets. This means you own a small part of a large collection of investments. Mutual funds are managed by professional fund managers who have the expertise to make informed investment decisions. They make investment decisions on behalf of the fund's investors, aiming to achieve the best possible returns. This can be helpful for investors who don't have the time or expertise to manage their own investments, providing peace of mind. One of the biggest advantages of mutual funds is diversification. By spreading investments across various assets, you can minimize risk. By investing in a variety of assets, you can reduce your overall risk, as the performance of one asset can offset the performance of another. Additionally, mutual funds offer affordability, allowing you to invest in a diversified portfolio with a relatively small amount of money. This makes them accessible to a wide range of investors. However, mutual funds come with fees. These fees can vary and may impact your overall returns. These fees are charged by the fund company to cover the costs of managing the fund, including administrative expenses and fund manager salaries. Be sure to understand the fees associated with a mutual fund before investing. It's important to compare different funds to find the one that best fits your financial goals and budget. Section 5. Choosing your investments. Choosing the right investments depends on your individual circumstances. Consider your financial goals, risk tolerance, and time horizon. If you're young and have a long time horizon, you may be able to take on more risk. Stocks, with their potential for higher returns, might be a good option. As you get closer to retirement, you may want to shift towards more conservative investments, such as bonds. It's crucial to diversify your investments. Don't put all your eggs in one basket. Spread your money across different asset classes, such as stocks, bonds, and real estate. This can help reduce your overall risk. Before making any investment decisions, it's essential to do your research. Understand the risks and potential rewards of different investments. Consider seeking advice from a financial advisor. Section 6. Managing your investments. Investing is not a one-time event. It's important to regularly review and manage your investments. Monitor your portfolio's performance. Track how your investments are doing and make adjustments as needed. If an investment isn't performing well, consider selling it and reinvesting the proceeds elsewhere. Rebalance your portfolio periodically. As your investments grow, the asset allocation of your portfolio may shift. Rebalancing involves selling some assets and buying others to maintain your desired asset allocation. Stay informed about market trends. Pay attention to economic news and events that could impact your investments. However, avoid making impulsive decisions based on short-term market fluctuations. Section 7. Tips for beginner investors. Starting your investing journey can be overwhelming, especially with the vast amount of information available. Here are some practical tips for beginners. 1. Start small. You don't need a lot of money to begin investing. Even small amounts can grow significantly over time. Start with a small amount that you're comfortable with and gradually increase your contributions over time. 2. Invest consistently. The key to successful investing is consistency. Regular contributions, no matter how small, can make a big difference. Make regular contributions to your investments, even if it's just a small amount each month. 3. Be patient. Investing is a long-term game. It requires patience and a steady approach. Don't expect to get rich quick. Short-term losses are normal and should not deter you. Be patient and let your investments grow over time. 4. Seek professional advice. If you're unsure about where to start or need help managing your investments, consider seeking advice from a financial advisor. They can provide valuable insights and guidance. Remember, investing is a journey, not a race. It's important to stay informed and adapt as needed. By following these tips and staying informed, you can set yourself up for financial success. Stay committed and keep learning.